Hey, this is Brian from KineticTrader.com, and I'm going to briefly summarize some strategies using credit spreads with weekly options. So credit spreads, for those that are totally new to option trading, is a popular strategy where you sell one strike and buy a farther out of the money strike. So with a put option, you'd sell one put and buy another put, and vice versa with the calls. With weekly options, it's become a popular strategy because you can write these out and they start seeing rapid time decay quite quickly, even the same right after you wrote them, if you're paying attention to where the stock's at and depending on where they're at in the expiration cycle. But as I mentioned in a prior video, weekly options are issued on Thursday morning and for expiration the following Friday, so you can just really follow those stocks that you're most interested in and really have an understanding of the range they're trading at and volatility that's in the underlying option, and then therefore make a decision on if you're going to do a put spread or a call spread. For example, a put spread, if you had Amazon here at 204.38 is the current market price, and you thought, for example, that the stock's going to stay above $200 by, let's see, Friday expiration, which is only 2 days away. And then you could write and sell a 200 put and buy a 195 to protect any risk of big downside. And with it only having 2 days of expiration, you're not going to get a big time premium, 31 cents or $31 per spread that you're going to realize. The risk, though, being that worst case, if the stock got down in 2 days down to 195 or closed near 195, your worst case risk is that you'd lose the difference between those strikes, so 200 minus 195, or $500 per spread, minus the $31 credit that you'd receive. So maybe $470 risk versus a $31 reward that you could get on that spread. But with only 2 days left, if you're familiar with the chart and how it traded and you felt comfortable with the rapid time decay that you could see with only 2 days left, then you could do a put spread with it out of the money there and hope that Amazon stays above 200 with it up at 204.38 up here. So it's a credit spread can be a little riskier with weeklies because you're having to write closer to the money to collect any time decay. As you can see here, for example, with only 2 days left, even if you wrote $10 out of the money, which percentage-wise is not a large move for a $205 stock like Amazon, you're only going to collect 10 cents or $10 on your short sale, and then offsetting that with that, you're pretty much making little to no money. This week, even though weeklies are introduced on Thursdays, and when I'm doing this video it's a Wednesday, because the monthly expirations are next Friday, they're already out in the market, and you can see here with 9 days to expiration, you can get an idea of maybe the premium you'd see, say, if you were to enter towards the beginning of when a new weekly is introduced. So say you waited till tomorrow at the open, it would kind of give you a better gauge roughly of maybe what you'd realize with the premium selling them right when they're introduced for each weekly's week. So if I sold this same spread, you can see you can get $99 or roughly $100 per spread versus the 31. So you just have to measure risk reward and look at where the stock's trading at and be a little more familiar with trading range and the market overall, and where the stock's been, to get an idea of where to write a spread. And generally what people do is, with such a short time decay on these options for weeklies with spreads, people will write their short strike at support and hope that the stock, with only a few days to expiration, stays above that support level, and then they'll just redo it the next week. If it gets too close to it, or you just have an idea of what your risk reward is before entering the position, you can close it out before it gets to your short strike or roll it into the next week. So those are some of the main strategies. I might do another one expanding on this to include what's called the Wheel of Fortune strategy, where you're doing cover calls with credit spreads. So put spreads, you can write them at support, and credit spreads at resistance, and try that strategy each week for weekly option income without having to take the stock. And again, always know your risk reward before entering these positions. Alright, thanks.